Good morning, everyone, and thanks for joining us today. My name is Brian Anderson. I am a partner in our insurance services practice based in Atlanta. I'm joined today by Brandy Shy and Michael Palm. Brandy is a tax partner in our St. Louis office focusing on insurance tax, and Michael Palm is a managing director from our state and local tax practice focusing on in the insurance industry. So, just a reminder, if you're here for CPE credits and not just to see our smiling faces, make sure you click the pop-up buttons. We will not necessarily pause for those, so you'll hear a ding, they'll pop up, and make sure you get your credits. So for the federal tax part of our agenda today, we're going to talk a little bit about some key dates and players coming out of last month's election, look ahead to what's going to happen for the rest of the year as far as any legislation. Look to next year. 2025 is going to be a big year for legislation around tax. We expect that some things are going to happen finally. Past couple of years, we've kind of talked about something might happen. Hasn't happened. Nothing significant's happened at least. But next year is a big year, so we'll get into that. Talk about some of the implications coming out of the election last month. Talk a little bit about the U.S. economic environment. You have to keep that in mind when we're talking about changing tax legislation. Then just kind of talk about the year in review, and then we'll switch it over to a state and local tax update. So let's dive right in and talk about key dates and players coming out of last month's election. So on November 12th, Congress went back into session about a week after the November 5th election. And the next day, the Republicans, who are now in the majority in both the House and the Senate, went ahead and elected their leadership in the House that the Republicans retained. Mike Johnson was the leader before, and he was reelected as leader, so he will continue his tenure as leader of the House. In the Senate, because now the GOP is a new majority, where the Democrats were before, John Thune was elected as the new leader there. Prior to that, Mitch McConnell has kind of led the Senate Republicans for quite a while now. Actually, he's been on a record run as the leader. He has announced his retirement as of February, so he will no longer lead the Senate GOP going forward, and John Thune is not going to take over. Next key date there is actually today. Appointment of electors by states, that will occur today. We'll talk about some other legislation that's going on today as we get into it. But going forward, those electors that get appointed will cast their votes on the 17th. A big date to keep in mind is December 20th. Government funding ends on December 20th. We're going to talk a little bit about some appropriations bills that need to get passed every year that really have not been passed as of right now. So that's not great. We'll talk a little bit about that. Those electoral votes will be delivered to Congress on the 25th of December. And then another big date that you're going to hear about soon hasn't really been talked about a whole lot in the news, but back in 2023, we suspended the debt limit. If you recall back to 2023, there was a lot of discussion about that. Kind of kicked the can down the road, and that suspension is going to end as of the first of the new year. So something's got to happen there so we can avoid defaulting on the U.S.'s debt, which obviously is not a great thing. And then on the 3rd, we'll have the new Congress convening. The 6th, the electoral votes will be counted. The January 6th is probably a date that most people will remember now. And then on the 20th, we'll have the actual inauguration and install the new administration. So some key players after the election. As I mentioned, the House has, in the House, the GOP has retained their majority. The current chairman of the Ways and Means Committee is Jason Smith, the Republican. The Democrat ranking member is Richard Neal, and those are both on the Ways and Means Committee. And the Ways and Means Committee, just as a refresher, is where tax bills have to begin in the House, and that's where they originate. So Those two members are quite important to tax legislation, to keep them in mind as we go forward. On the Senate side of things, Ron Wyden is the Democrat who is the current chair of the Senate Finance Committee. Mike Crapo is the current ranking member from the GOP. Because the Senate has now flipped from a Democrat majority to a Republican majority, those two members will flip. Mike Crapo will be it's expected that he will be the new chair of the Senate Finance Committee, and Senator Wyden will now be the ranking member. Let's go to the next slide. Key numbers. We've talked about that on presentations in past years, but just as a refresher here, the key number in the House is 218. There are 435 seats in the House, and so you need a simple majority to pass a bill in the House, and that is 218. In the Senate, the magic number is 60. There are 100 members of the Senate, but in order to avoid a filibuster, you need 60 members to vote on your bill. There are other ways to get things passed in the Senate. We'll talk a little bit about the budget reconciliation process. If you recall back to 2017, that's how the TCJA, the Tax Cuts and Jobs Act of 2017, that was really the last piece of major tax legislation we had. That was passed along party lines, and the GOP did not have a 60-member majority at that point. So they had to do that through the budget reconciliation process. And whenever you do that, you're limited on what you can pass because it must be budget neutral on the deficit. Now, a little bit debatable on whether what we mean by budget neutral, because there's a lot of different ways we can slice things. But even without having a 60-member majority in the Senate, things can get done via reconciliation. So let's talk about some possible implications of the new administration and the majorities in the House and Senate by the Republicans. So unless you've been living under a rock, I think you probably heard that Donald Trump has been elected president again. So the Republicans have the White House now. The Republicans have taken back the Senate, as I mentioned before. They will now have a 53 to 47 majority. And then to the extent there are any ties, the vice president can always cast a vote to break that tie. So they can afford to lose 3, maybe 4 seats and in the Senate. So it's fairly evenly divided still. We've been in that situation for a while at this point. So a little difficult to get things passed in the Senate. In the House, the majority has been maintained by the GOP. The Republicans have won 220 seats. The Democrats have won 215, actually. That one that was decided as of December 2nd has now been decided. So it's 220 to 215. There's a caveat in there, though. Remember, we talked about on the last slide, 218 is the magic number in the House. So based on the 220 to 215, they'd only be able to afford 2 people defecting. The problem that the GOP is going to have in the House, currently at least, is that 3 House members have either been elected or have been put forth by the Trump administration for the cabinet. Matt Gaetz, if you recall, was put forth. He is no longer going to be in the cabinet, but he has resigned his House seat. So there will be a special election in Florida for his seat going forward. And then there are 2 other members. Elise Stefanik of New York is going to be the ambassador to the UN. So that's 1 less out of the 220, or 2 less out of the 220. And then there's 1 other, Mike Waltz of Florida, the other GOP member who has been put forth for National Security Advisor. So really right now we're talking about 217 to 215 in favor of the GOP. And so again, 218 is needed for the majority. There's going to be a special election for those 3 seats. So remains to be seen. It could flip back to the Democrats, theoretically. In the Congress, so what's kind of top of mind here? We had, I think, what we would consider a Republican sweep. And so back in 2017, when that bill was enacted by the budget reconciliation process, we had to be budget neutral. So some of those tax favorable provisions that were in that bill actually have expirations in them. And that expiration is occurring next year in 2025. So we're going to go back to where we were prior to 2017 on some of those provisions. And there's certainly appetite by the Republicans to get a lot of those things extended permanently. But again, in order to get to that, we're probably going to have to go down the budget reconciliation process again. And in order to kind of get those tax benefits extended, we're going to have to find, quote, pay-fors. So there's going to be some wheeling and dealing to see where those tax cuts are going to be offset by increases. The next provision there, the child tax credit, that's really the thing that's been holding up, in my mind, things getting done in the past couple of years as far as tax legislation. The Democrats want that expanded and made permanent. Republicans don't. So now that we've had a Republican sweep, it's kind of questionable as to whether that's going to be in there or not. I haven't heard a whole lot about it in the past couple of weeks about there being a lot of appetite on the Republican side, but we'll see if they need to get Democrat support to get some of these bills moved along. You're probably going to have to include some of that, or at least some expansion of it. The next thing there is really what we call the big three. Section 174 capitalization, 163J interest expense disallowance, and the 100% bonus depreciation. Those things have had bipartisan support for several years at this point, and we've been talking about, well, it's likely that these are going to get passed, but they haven't gotten passed. Again, the child tax credit was holding it up in my mind for a lot of the time, but those three still have bipartisan support. And so I think the most likely scenario, what we're hearing right now, is we will get those things done finally. Unfortunately, I think we're going to be waiting a little bit. The most likely scenario we're hearing right now is it's going to be August before we pass those things. 174 capitalization, I think, is one of the biggest things that have been affected my clients in the insurance industry. There is appetite to have that repealed retroactively. How that retroactive occurrence might happen remains to be seen, whether there's going to be a mechanism to do it on the return itself, or you're going to have to go do amended returns. To the extent it gets done in August, I think it's probably going to be difficult to do it on the return itself because we'll be well into filing season at that point. So it's probably going to be the amended return process, I would assume, if we have to wait that long. Some of the presidential priorities from the Trump administration, TCJA permanence, we've talked about that. There's appetite among, obviously, the Trump administration and most of the GOP to make some of those provisions permanent. And a lot of the focus on tax legislation in the new year is going to be on making some of those items permanent. The next item there are tariffs. So I think we all know when we're on the campaign trail, we hear a lot of things that are kind of thrown out. Sometimes you chalk that up to it's campaign rhetoric. It's not really going to happen. I think when tariffs were originally talked about, we could probably throw it into that category that, that's a terrible idea. I don't think that's going to happen. It's not likely. What we're hearing now is it's actually becoming more and more likely that we're going to see some tariffs. The focus there seems to be primarily on China, Mexico, and Canada from the Trump administration. What we see as far as a percentage, I don't know that anybody really has a good idea right now. The 10% baseline on everything was thrown out, and 60% on Chinese goods. We don't have a really good sense right now for where that's going to head, but it does seem a little bit more and more likely that that's going to get some serious discussion. Next item there, 2024 proposal. Brandy get a little bit into some of the bills that have been put forth in the past couple of years that are will get renewed. Some of the big three have been in prior bills that have failed. Next item there, corporate tax rate. The Trump administration has thrown out a 20% tax rate. That would be a 1% reduction overall, and then a 15% for U.S. manufacturers. Last thing there, increase with a question mark. We threw that in there because there actually seems to be some support among the GOP for potentially a small increase in the corporate tax rate. And that's getting talked about as far as to the extent we need to extend some of these TCJA provisions and find some offsets, the corporate tax rate might increase a bit. So I think what we're hearing is if we do go down that path, maybe 23, 24%, so not significant, not back up to 35 where we were before, but potentially an increase. I wouldn't say that's likely yet, but again, they're going to have to potentially find some things to pay for some of these tax provisions that we want to extend on the TCJA. The IRA, Brain, I'll get into a little bit. A partial repeal of some of the provisions of that are being talked about. Next item there, aid to working class. Another one of those campaign rhetoric items I would have put in that category was taxation of tips, the exemption on taxation of tips. I think their general consensus in the industry was that that's not going to happen. And then now we're hearing it's kind of likely that we're going to see something there. Maybe it's going to be temporary, just to kind of check that box, if you will. But it is seeming more and more likely that we might see some provision on taxation of tips. And then personal tax, 529 savings expansion, and then some of the individual credits that are still out there talked about expanding the child tax credits. Okay, so looking forward, we have Congress in session right now. It's the quote lame duck session is going on right now. The immediate focus right now, because nothing has been done, every year we have 12 appropriations bills that need to get passed for the October 1 to September 30th fiscal year that the government is on. And so each year by September 30th, that needs to get passed in order to fund those 12 different areas. Oftentimes, what we've seen in the past few years because of the divided Congress is we'll get these continuing resolutions. We are under a continuing resolution right now because we didn't get those 12 bills passed as of September 30th. And so at the end of September, we did get a continuing resolution for those four things. And those are being debated right now. In fact, the National Defense Authorization Act is actually going to vote today. And so we expect that those will be passed prior to year end because we're coming up against the deadline for government funding. And obviously, it's not a good thing when we have to shut down the government. Farm Bill is another one that's in there. And then the other big deadline that we talked about in the beginning, the debt limit being suspended, that's going to be ending on the 1st of January. I don't think we're going to see anything for that debt limit suspension extension prior to January 1st. It's being talked about that we'll hear debate on that in the new year when Congress comes in on January 3rd. So the expirations are the Senator of legislators' tax discussions right now. The TCJA of 2017, the provisions that are expiring will be really first on the agenda in the new year. And it's safe to say that there are more of the individual provisions that are expiring in the TCJA versus the corporate. If you'll recall, the individual tax rates were lowered. The highest marginal rate was lowered from 39.6% to 37% as a result of the 2017 Act. That's going to go back up at the end of 2025. but the corporate tax rate, at least right now, absent anything else, is going to remain at 21%. So just a little bit on the individual tax, because that rate is going to be coming down or going back up, excuse me. There are also other provisions, itemized deductions that are going to be going away. This is kind of an example of a person with $100,000 of income and a standard deduction. This would be the projected increase in taxes that individuals are going to look for, unless we get something done as far as making some of the TCJA things permanent. And actually, the first point there, if we were to extend all of the TCJA provisions, that would increase the deficit by about $4 trillion. So I think it's probably safe to say that we're not going to see a full extension of everything in the TCJA, because we're not going to be able to find $4 trillion of offsets at this point, and probably unlikely that we're going to have enough Democrat support to get all those things done, but we shall see. Here's some of the TCJA expirations. The Section 199A qualified business income, currently a 20% deduction, that goes away after 2025. Big one that some of our individual clients are focused on is the estate and gift tax exemption. If you recall, back in 2017, that basically doubled, and it's going to go back down and get cut in half, a little bit indexed for inflation, so it'll be a little bit higher than it was in 2017. Talked about the tax rate changes that are upcoming and the personal exemptions and deductions. The SALT cap's another big one, that the $10,000 limit on itemized deductions for individuals will be going away. The talk right now is that that's probably going to be reinstated, although at a higher cap. The number thrown out right now is about 25,000. So we'll see what happens there, but there's a lot of support for reinstating that one among both parties. Mortgage interest deductibility is going to go back up to 1 million thresholds. Miscellaneous itemized deductions coming back, and the return of the AMT, or at least the threshold, is going to go back down. So you'll see that a lot more taxpayers will see that come into play again. Some other changes really focused on credits. These credits on this slide have been around for a while, but they have never been permanent. They've been temporary, and they've been extended every now and then. A lot of my clients in the insurance industry have taken advantage of the paid family and leave credit, percentage of an amount paid to qualifying employees during leave. There's definitely support to get that done again. New Markets tax credit, talk about making that one permanent. Again, that one's not been permanent before. So I don't know if there's a whole lot of appetite to make that permanent now, but at least to extend it. And then the WOTC credit, extending that one is certainly in the cards. So I'm now going to hand it over to Brandy Shai, who's going to talk a little bit more about the U.S. economic environment.
Thank you, Brian. I appreciate that. Thank you, everyone, for joining. We're excited to have you today. Okay, so a lot of the things Brian talked about in terms of TCJA, either making it permanent or extending the provisions, it's all going to cost money. And I think that has to be weighed with where we're at from a deficit perspective. So we want to talk a little bit about where the economy is at, where is the deficit at, and how is that going to impact the legislation we see, the potential legislation we see coming for 2025. So in terms of our deficit right now, generally the deficit historically over a 50-year average has been at 3.7% of GDP. And in the chart there, you can see that right now we're trending around 7% of GDP, so significantly larger than the historic average. And also on the budget line, at the bottom of the outlay section, you can see the net interest that we're paying as a country on our national debt. And it's projected right now we're at 3.1% of the budget that's related to the net interest, and that's expected to increase to 4.1% by 2034. And that's going to end up passing all of the other outlay line items except for Social Security and Medicare. So it really is going to continue to be a significant part of the budget. In terms of actual dollar amounts related to the deficit, when President Trump takes office, we're expected to be at 28 trillion of deficit. By the time he leaves office, another 7 trillion is expected to be added to that. But if we look out 9 years to 2034, we're expecting another 20 trillion to be added to that. So really a $48 trillion total by 2034. Currently, we're at almost 100% of GDP in terms of our debt level. And at the rate this is projected to keep going, we would exceed 200% by 2047. So again, a pretty significant growth and something that is going to have to be considered from a neutrality perspective as it relates to tax legislation. This quote is really impactful for me in terms of what would it take if we wanted to pay off our debt over the next 10 years, over the next decade as a country. And that would require a 60% cut in our national spending. And what does that translate to? What does 60% mean? It would mean we would have to cut Social Security, Medicare, Medicaid, and food stamps. That would get us to 60%. Or if, as an alternative, we would eliminate all spending other than defense and Social Security. So as you can tell, big numbers there and huge cuts. And it feels very daunting in terms of how we could potentially even come close to paying off our debt over the next 10 years. And again, this chart is just showing the likelihood of us paying off our debt. Certainly over the next presidential term, it seems like a very, very far reach without some significant large tax increase. And if we think about all the things Brian just talked to us about, many of those items are tax cuts. So when we say, is there a potential for a corporate tax rate increase? Well, certainly all of these take balancing. And with tax cuts, there has to be revenue raisers. And so that's something I really, for those of us on the phone that are in the insurance industry, we need to be aware of, because oftentimes if we look at TCJA and even at tax legislation prior to that, the insurance industry is often looked to for revenue raisers in tax bills. And that's because the general population thinks the insurance industry is significantly profitable, and therefore it is tolerable for revenue raisers to be pushed to the insurance industry. That being said, we've got great insurance organizations and lobbyists that help combat that, but certainly something to keep in mind as all of these favorable tax items are pushed through. We know that there has to be revenue raisers, and what are those going to be? And truly, I think this picture embodies what the tax writers of this new tax legislation might look like, because we just had the privilege recently of listening to Kevin Brady and their process on the TCJA writing and how difficult that was to balance. And that wasn't neutral. That wasn't deficit neutral, but it was close in the grand scheme of things. And I think it's going to be even harder in light of what Brian said, that just extending the TCJA provisions puts us in a $4 trillion hole. So a lot of revenue raisers that need to be considered to make this a feasible bill that will get through Congress, both House and Senate. Okay, so let's quickly talk about what we saw in 2024. As Brian mentioned, we had the Tax Relief for American Families and Workers Act. This is the one we were all holding out hope. It quickly passed through the Senate and then through the House, and then got held up in the Senate, largely because of that child tax credit issue. However, it contained the big three, which is what everyone was excited to get pushed through. Most importantly for my client base and for many of you on the phone, was the repeal of 174 capitalization requirements for domestic spending. We were still going to be required to capitalize and amortize over 15 years for foreign expenditures, but for domestic, it would go back to immediate expensing. And I know many of us on the phone here were very excited for that to be repealed. However, as we mentioned, it got caught up in the Senate. We didn't see anything actually happen. How was that bill going to get funded? That bill's revenue raiser, how it was going to be brought towards that neutral space, was the early cutoff of the employee retention tax credit. And if you have listened to any tax presentation in the last 24 months, it's likely you've heard about the employee retention credit and the extreme fraud that has been surrounding this credit, mainly because there were a lot of boutique credit firms that popped up soliciting advertising for this phone, likely got emails and phone calls talking about how your company was missing out on hundreds of thousands of dollars worth of credits by taking advantage of the employee retention credit. And as we know, the IRS is now rejecting a lot of those credits. And that was going to be part of the revenue raising for the Workers and Families Act, was to cut off new submissions of employee retention credit. And that was going to generate enough revenue to help make that bill feasible. Now, the further out we get from 2024, now we're at the end of 2024, is this going to be a feasible revenue raiser? We'll see, likely not. The IRS has pivoted and has developed an automatic kind of rejection process for highly risky employee retention credits. So that's the process they've used moving forward. So, the likelihood of this cutoff method being used for a revenue raiser is waning. 2 court cases, more I'm not going to spend much time on. There was hype around it, but really it didn't produce much significant change. The next one, though, was the overturning of the Chevron doctrine. And, that is important in that it provides the courts the deciding interpretation of rules, whereas previously the regs and IRS interpretation was our guidance. Now, what does that mean? Perhaps there's greater ability to challenge those interpretations. But as we know, when we're working in the court space, that takes a lot of time and it's usually very costly from a legal fee perspective. So it'll be interesting to see how this plays out going forward, but it is kind of a big change in the interpretation of tax rules going forward. The effects of the IRA, as we can see, I'll just briefly touch on this. The use of clean energy investments has gone up significantly since the IRA. And I think the interesting thing about this map in particular, as we know, Trump has made it very clear that he wants to repeal parts of the IRA. But if we look at where the benefit of some of these clean energy credits, tax credits are happening, it's in often Republican-dominated sections of the country. So it is kind of an interesting dynamic in terms of who's benefiting. So we'll see how that plays out in terms of tax legislation going forward. And this is just a quick FYI, a lot of credit-related guidance that we've seen just for you to have in the slides. I'm not going to spend too much time on it at all here. Okay, and now I'm going to turn it over to Mr. Michael Palm to give us all of our state and local updates. Thank you.
Hello, everyone, and we'll take a quick spin through the state and local developments now that apply to the insurance industry. So starting off, I'll just kind of bring out the old crystal ball and think about what's going to go on maybe for the next 12 months or so. State revenue growth is definitely slowing down. Per the National Association of State Budget Officers, fiscal year 21 and 22 were the fastest 2 years in recorded history that the budget officers had done. General fund revenue then decreased 1.1% for fiscal year 23. It's anticipated that we're going to probably be an increase of 0.6% for fiscal year 2024 when everything gets wrapped up. And then they're anticipating fiscal year 2025 will show an increase of 1.6%. A lot of this, obviously depends upon, federal stimulus. We're definitely in wind down there, but that definitely impacts how much state revenue the states have. There's also going to be an all eyes on Washington, D.C. for the trickle down. We've heard Brian and Brandy kind of talk about what's going on at the federal level. Well, the states are going to be, looking at what's going on at the federal level to see what kind of impact that's going to have on state revenues. My guess is that state legislators will probably do a wait and see to make sure that there's going to be, something happening at the federal level. You don't want to initiate any kind of major tax reform until you kind of see what goes on at the federal level. So I would anticipate 2025 legislative sessions to have some bills, but maybe not a lot of actual passed legislation at the end of the day. From an insurance perspective, state premium tax continues to be a very strong and steady source of state tax revenues. It's generally right there around, 3% of the total state tax revenues. We've already kind of talked about the fact that insurers are generally viewed as deep pockets when it comes to providing state revenues. Other trends that probably are going to see for 2025 legislation, we're going to probably see some tax cuts continue and the incentive trend continue. So since 2021, all states other than Alaska and Nevada have made some kind of tax cut. Most of this has been, on the individual level where it's individual income tax reductions or property tax reform. That's gotten most of the play. Obviously, we hear, because of the, offices we sit in, we hear a lot about, the corporate provisions, but really most of the activity has really been at an individual level. For 2024, 28 states passed or proposed some form of tax credit provisions that would have been applicable to the insurance industry. We're probably going to see this again, deep pockets. That means that the insurers have the ability to invest in these type of credits. But one caution here is, for the states that you're involved in, keep an eye out on income tax credit revisions that might be coming. A lot of times states ignore insurance companies when it comes to income tax credits, and those might not necessarily apply to the premium tax. If you see a credit that comes through, it's in a legislative proposal or there's going to be a change to it, and you think that might be beneficial to you, while it's in that legislative phase, then's the time to, approach legislators at the state level and try and get that to be applied against premium tax as well. And then the last bullet point here is, we've definitely seen an increase in legislative activity when it comes to natural disaster mitigation. We've seen a lot of fire tax and flood and wind assessments. We're probably going to see a lot more of those. These, continue to be issues across the industry and across the states. These will definitely put a direct increase on insurer burdens, or in some cases, the states will front the costs of these programs onto insurers who have to then recoup the costs somehow from policyholders. And then last but not least, Florida continues to be a problem child as far as the state goes. Premium increases in the state, especially on homeowners policies in the coastal areas, are pretty much out of control. State legislators, and we'll have a bill that we'll talk about here in a minute, are really looking for anything they can do to get some of these costs under control for the citizens there. There's also a push for the state-run Citizens Property Insurance Corporation to reduce the number of policies in force, and that's called a depopulation program by the state. And that's where these policies are being transferred back to private insurers. And the issue there is they have so many policies being covered by the state-run corporation that if it failed, they would have a massive policyholder assessment that would have to come out. So something to continue to watch for. Things are definitely happening in Florida. The one item that is usually the top item for all of our clients, whether they be insurance companies or non-insurance companies, is remote employees. I think the issues and considerations that you need to worry about when we talk about these things are well known. Remote and hybrid work issues were really brought to light during the pandemic, and the insurance industry was an employer that was able to use and pretty much embrace a remote workforce. I think most of the insurance companies that we work with for sure have some form of hybrid workforce, if not fully remote at this point. And we don't really necessarily see that changing. What you definitely need to do, though, is, and it's very critical, that if you're an employer and you have a remote workforce, you need to make sure that you're developing a corporate policy, document where and when your employees are not working in a standard office, because these issues do pop up. So number one, you've got nexus issues that can pop up for a variety of taxes like income tax, property tax, sales use tax. And this is definitely a problem when the employees might work from a location where you as the employer are not currently licensed. It just leads to, nexus for all these other taxes. Withholding issues, clearly you need to make sure that you are understanding which jurisdiction controls and may require you to file additional registrations and filings if you weren't already, again, registered in a particular state. Employee income taxes, maybe are not necessarily you as the employer's concern, but employees definitely need to be aware of the issues, and some of those issues can flow over to, again, you as the employer. So, if you have an employee that decides to work at the beach and happens to want to work overseas, well, that might cause you some concerns as to now whether you're doing business in an overseas location, and maybe for them, whether maybe they needed a visa to even do that kind of work. So it's best to put all these things into policies and procedures so that everyone is understanding what's going on. I've got a number of cases here that are listed out. We know that the U.S. Supreme Court declined to hear the New Hampshire versus Massachusetts issue, where Massachusetts was imposing income tax on workers that had previously been assigned to Massachusetts offices, but during the pandemic were working at home in New Hampshire. Again, U.S. Supreme Court fails to hear that case, and now we're left with a lot of localized cases. And here's just a smattering of them. And we're going to continue to see these develop as to, taxes and the issues that are there. The next slide as well, more cases. Again, we're going to see this at a local level instead of at a state level. Another state trend that I wanted to touch base on, I'm not going to spend a lot of time on this one, but there is a growing trend of class action litigation against property casualty insurers and their claim practices on totaled vehicles. And we're seeing this in a number of states. I would definitely caution you, if you're a property casualty insurer, to review your policy language to understand what is to be reimbursed in these cases. And then also for the states that you're doing business in, what are the applicable state laws? These cases can get to some very large numbers very quickly because, again, class action lawsuits, it's not just one person asking for sales tax on one vehicle. It's hundreds, thousands of, policyholders doing the same thing. So here's a couple of cases. Definitely take a peek at these if this is the type of business that you're doing, and then a few more cases as well. These cases have been popping up for the last several years, and we're going to continue to see these.
Michael, can I jump in
yes.
with a question from an attendee, please?
Absolutely.
Regarding nexus issues for insurance companies, is this mitigated somewhat by premium taxes and in lieu of provisions?
Well, absolutely. So again, the nexus issues when you have remote employees are similar across the board, whether you're an insurer or non-insurer. You want to make sure that you're looking to see whether you as the employer that particular employer is licensed in a state or not. So if you're an insurance company, you're licensed in the state to conduct business operations by the Department of Insurance in that respective state, obviously then you're going to be filing and paying the premium tax. Having a new employee in those states is not going to change your premium tax filing. It's not going to subject you to income tax if you weren't already subject to it in those states that impose both, right? But you may have some additional filings where you might not necessarily have had it in the past, such as sales use tax or property tax, because you might not necessarily have had any of those activities. So you do have to watch for that, because the in lieu of protection that grants you an exemption from the income tax probably does not exclude you from property tax or sales use tax. So definitely make sure that you're keeping an idea as to where your employees are, and making sure you're tracking that, and then see how that matches up with your filing, that you're doing already. Great question. Moving over to some key developments for the year. Florida House Bill 7073. This did update the state's Internal Revenue Code conformity date to January 1st of 2024, which previously was 2023, and it created or revised a number of credit tax provisions. But the one troubling provision that was in the bill is the requirement for insurance companies to provide a 1.75% discount, which is the premium tax rate, right, in Florida, on policies covering flood or residential coverage, as well as a discount for any amount of respective fire marshal tax that would have been applicable on those homeowner policies. These discounts apply to policies with coverage for a 12-month period with an effective date on or after October 1st of 2024 and going through September 30th of 2025. As we all know, these type of things, even though it might have been specified in the original bill as a one-year issue, who knows, will we see an extension of this credit to future years? My guess is, again, going back to that discussion that Florida is a problem child, wouldn't surprise me to see this extended. This policyholder discount then that you are receiving or you're providing to your policyholders, then you recoup that through a premium tax credit. And then if you have excess premium tax credits, those are refunded from the state to the insurer. This is a problem because it also requires disclosure to policyholders on the deck pages. And you also have to disclose this again in your insurer's quarterly and annual statements. This is effective and it's going forward. So, it's already in play. So if you, haven't put things into motion to track all this and, put it on deck pages for policyholders, you're behind the curve. I would urge you to immediately get busy, because this could, come back to bite you a little bit. So staying in Florida, the State Farm case was ultimately decided here. The First Court of Appeals in Florida did hold the Department of Revenue was correct in their position where they were excluding the proration add back for purposes of determining the add back for tax exempt interest. So common insurance practice is to, instead of take your tax exempt interest, it would be to subtract off the proration piece of that. Florida took exception to that. The Department of Revenue's position is that Internal Revenue Code sections 103 and the Florida statutes 220.13 don't have any reference to the proration provision, so they don't permit a deduction. It seemed to be the wrong answer, but it's now the answer we're stuck with, unfortunately. Moving over to Illinois House Bill 4951. Again, this was a budget bill, had a lot of tax credit provisions in it. However, from an insurer perspective, as well as non-insurance, this does create a new extended cap on corporate net operating loss carry-forward deductions. The current cap is $100,000. This is now going to increase that to $500,000 for tax years ending on and after December 1st or 31st of 2024 and before December 31st of 2027. So another 3-year block. Again, if you are limited on your NOL usage, you get to extend the normal 20-year carry forward by that year. So you don't necessarily lose it, but you do get pushed out. The next item that is on the listing here is Massachusetts Regulation 830 62C.8.2. This is a proposed regulation. Looks like it's going through. There was some public hearings that were through the end of November. I haven't seen any published report off of that yet. But what this proposed regulation would do, it would require motor vehicle insurers who make payments on auto policies for auto repairs in the state of Massachusetts during the calendar year to file an annual information return with the commissioner and then also provide a copy to the repair shop. These information reports basically would need to show not only the amounts of the coverage and the repair that was being paid, but also the sales and use tax. This reporting would become effective retroactively going back to January 1st of 2024. The reporting for these would be due to the repair shops, similar to any other 1099 type reporting by January 31st. So we're almost on top of that. And then the reporting that would need to go back to the state would need to be filed by March 31st of that following calendar year. For those of you doing business in New York, this is very similar to the law that they have there that they passed in 2009. If this goes into effect, please note that you need to make sure you're taking care of this because this does carry a potential penalty under Massachusetts statutes of $25 to $500 per non-filed return. So that would be per information return not filed. So that could obviously get to a fairly hefty penalty for failure to comply on this. So it's a wait and watch, but I would try and start putting things into motion to make sure that you can report this as needed. Moving over to the nationwide agribusiness case. Again, this is now on appeal with Michigan Supreme Court level. But what we have here is that Nationwide had some excess credits for the Michigan Automobile Insurance Placement Facility. And they had excess credits in one company, but had another group member they wanted to try and use the credits in. They filed a unitary premium tax return to take advantage of the credits. That was denied ultimately by the Treasury Department in Michigan. And on the latest go around, at the Court of Appeals, that got reversed and sided with Nationwide. And basically what the state was looking at there was another court case. It's SOAVE, S-O-A-V-E, which basically also looked at some unitary filing groups and shared credits. And so the judges there have applied the same reasoning to this, although insurance companies typically file separate returns when it comes to premium taxes. So it's an interesting case, going to go up to the Supreme Court level, and we'll see, how that ultimately gets decided. Staying on cases that are, this one's a little bit more decided, but the North Carolina Farm Bureau, this kind of brings to an end the issues that this industry was having, or all of us, all taxpayers were having with the state, where the Department of Revenue was denying tax credits that were purchased through partnership investments, particularly energy credits. Here the department had appealed the win for the taxpayers to the state Supreme Court, but ultimately both parties jointly requested to dismiss the appeal in March of this year. And so this is now a dead issue. Credits are good. So if you've had an issue with credits and you still haven't received benefit of those, benefits should be there now, and it's no longer a disputed item. And then one last thing that I wanted to chat about is Oregon. So this was a defeated general ballot measure. So ballot measure 118 would have imposed a brand new additional 3% minimum tax on top of the already minimum tax that was already in place for corporations with gross sales that exceeded 25 million. And this would have started in 2025 if it hadn't been defeated by voters, and it was soundly defeated, 79% to 21% in the general ballot in November. This was kind of a wealth distribution play where this additional minimum tax would have been imposed on these large corporations and then redistributed to individual taxpayers in the form of rebates that were anticipated to be somewhere in the neighborhood of, $1,000 or more. It was interesting that the taxpayers kind of voted to not accept money, but cooler heads prevailed, and it was a good thing because, from an insurance perspective, Oregon domestics would have been hammered on this for retaliatory tax burdens because they would have had to add this into the retaliatory calculation for every other state that they do business in. So a good win for the insurance industry as a whole, definitely a great win if you're an Oregon domestic. And with that, I think brings us to the end of the session. Thank you all.